Navigating the landscape of small business financing requires understanding specific criteria, especially when applying through major non-bank financial institutions and preferred small business administration lenders like Newtek. Securing capital for expansion, purchasing equipment, or managing operational cash flow depends heavily on meeting baseline financial, operational, and credit standards. When evaluating potential borrowers, Newtek looks closely at personal and business credit scores. Generally, applicants should aim for a minimum credit score starting around 650, though higher thresholds of 700 or above are frequently required for specific funding products or newer business entities. Maintaining a strong credit history demonstrates reliable financial management, which directly impacts approval odds and dictates the interest rates and terms you might receive. Time in business is another critical factor in the qualification process. Newtek typically prefers businesses that have an operational history of at least 2 to 3 years. Established revenue streams and historical performance data give underwriters confidence in your ability to manage debt service obligations. However, options may still exist for newer businesses or startups if the primary owners possess exceptional credit profiles, industry experience, and adequate backup resources. Because Newtek handles a wide array of loan programs, including traditional term loans, lines of credit, and government-backed SBA 7(a) or 504 loans, the precise rules can shift depending on the exact product. For SBA-backed financing, companies must satisfy strict federal guidelines. This means the enterprise must operate for profit, be located within the United States, qualify as small under specific Small Business Administration size standards determined by receipts or employee counts, and be independently owned and operated rather than nationally dominant. Furthermore, business owners must typically be United States citizens or permanent resident aliens. Collateral requirements also play a major role in determining eligibility, particularly for funding amounts exceeding $50,000. Depending on the type of financing requested, loans and lines of credit may need to be secured by tangible business assets. This can include commercial real estate, heavy machinery, equipment, inventory, or accounts receivable. Asset-based financing structures allow lenders to mitigate risk by claiming a security interest in these properties if default occurs, making the presence of valuable company assets an advantage during underwriting. Preparing the correct documentation ahead of time streamlines the application journey and prevents unnecessary delays. Borrowers must generally provide comprehensive financial statements, including profit and loss statements, balance sheets, and cash flow projections. Additionally, you will need personal and business tax returns spanning the past couple of years, legal business licenses, a comprehensive business plan, and detailed descriptions of how the capital will be utilized to drive enterprise growth. Organizing these documents meticulously ensures that underwriters can quickly verify your financial stability and operational viability.